Another thing that shifts the demand curve is change in tastes or preferences. And that's just as simple as it sounds. If something is popular, people are going to buy more of it even at a higher price. Or for a given price, people are going to buy more of it. There's still a downward sloping demand curve for popular items. If the price of a popular item goes up, fewer people are going to buy it. If the price of a popular item goes down, more people are going to buy it. But at a given price, the more popular something is, the more people like it, the more people want it, the greater the demand. And if that popularity changes, if preferences change, if tastes change, the demand curve is going to shift. Change in expectations. And mostly this is around the change in expectations about future prices. So if you think that the price of a good is going to go up in the future and it's something you want, you're going to go buy it now. And so the present demand curve is going to shift to the right. At a given price, more people are going to buy a good if there's an expectation that its price is going to rise in the future. On the other hand, if you think the price of a good is going to fall in the future, you might hold off on buying it and you're going to wait for that price decrease, meaning that at a current price today, the number of people willing to buy it is going to shift to the left. Fewer people are going to buy it at today's price if there's an expectation that the price is going to fall in the future. And then finally, changes in the number of consumers. And again, just like with tastes, this one is almost as obvious as it sounds, meaning that the more consumers there are, the more of a good is going to be demanded at any given price. So if the population increases, or if the population of a particular age group increases and you're selling, say, health products and the number of elderly people increases, the number of consumers for those products increases, demand is going to go up. Similarly, if you're selling, say, toys, and the number of children increases, then you're going to see an increase in demand for toys. If the number of children decreases, you're going to see a decrease in demand for toys, meaning at any given price of toy, you're going to sell fewer toys if there are fewer children out there. It seems pretty obvious, but it is definitely one of the things that change in number of consumers will certainly shift a demand curve. I would commend to your attention a couple of slides that I have about the difference between a shift of the demand curve and a movement along this demand curve. You might want to look at those slides a little carefully. These are slides number 24 is the questions, and then the answers are on 25. And I would just suggest look at slide 24. Maybe even try to do the answers yourself or think about them at least before you skip over to slide 25 to see whether you got it right or wrong. And if you're confused about it, please send me an email. I would be happy to explain it to you, or come to office hours on Tuesday. I will be back September 10th for office hours, but spend a couple minutes trying to do it on your own, just to get your brain exercised. All right. The supply curve. So just like the demand curve, but opposite, the supply curve is the amount of a good that a producer is willing to sell at a given price. And just like the demand curve, we're going to have a supply schedule. Instead of decreasing, the quantity supplied is going to increase as the price goes up. So just like the demand curve, but opposite, we can have a supply schedule, which for any given price, and I'm going to use SUVs, sport utility vehicles, because the manufacturers are always thinking about how many of them are they going to be willing to produce for a particular model year, and the higher the price, the more they'd be willing to produce. So let's say we're a particular auto manufacturer, and if the price of an SUV is $15,000, they would be willing to produce, let's say, 10,000 units. But if the price went up to $20,000, they'd be willing to produce 15,000 units. And at $25,000, they'd be willing to maybe even double production to 30,000 units. And if the price rose to $30,000, maybe they'd be willing to add another 9,000 units. as you can see, this doesn't necessarily have to be a straight line. It's just saying for any given price, how many would the seller be willing to produce and sell? And the important thing is that the relationship is that the higher the price, the more the seller is willing to produce. And just like with the demand curve, we're going to have a supply curve with the quantity on the y-axis and the quantity on the x-axis and the price on the y-axis, and the supply curve is going to be sloping up. And like I said, it doesn't necessarily have to be a straight line. It can be some sort of a curve, but it's just sort of easier to just sort of draw the straight line for the purposes of this particular example, even though, of course, my supply schedule is nothing like a straight line. You can see a more elegant example in the slides in terms of what a supply curve could look like. And just as with the demand curve, we are going to make a distinction between a movement along the supply curve, which is that for a change in price, the quantity supplied is going to increase or decrease. The price rises, the supplier is going to increase production and sell more. If the price falls, the seller is going to try to reduce production and sell fewer of the item. And then, so a distinction between that, a movement along the supply curve, and a shift of the supply curve. And so, we're going to say the supply curve, supply is a relationship between price and quantity supplied. We have a line, we have a supply schedule. At any given price, you tell me the price, I will tell you the quantity that's going to be supplied. And so supply is this relationship between price and quantity supplied is the amount that we're willing to supply at any given price. However, of course, supply can change. Supply can increase or decrease. And just as with demand, we will illustrate the change in supply as a shift of the entire curve. And so an increase in supply means that at any given price, we're willing to supply more. And the supply curve shifts to the right. Now, this is, again, where we run into this sad situation because of the fact that these curves have been put on the side. So supply increasing, meaning that for any given price, we're willing to supply more. Unfortunately, based on the general up-down system that we use in most of our lives, the supply curve of the increased supply curve looks like it's under the original supply curve. But remember, up is this direction. Greater quantity means to the right. So an increase in supply means the supply curve has shifted to the right. And if supply decreases, if for any given price we're willing to supply less or fewer units, if supply decreases, and at any given price we're willing to supply fewer units, again, from the traditional up-down system of like that this is up, it looks like the supply curve is above that one, but actually its supply has decreased because down is in this direction, up is in this direction. Greater quantity, lower quantity. Lower quantity is to the left. So if this supply curve shifts to the left, it means that at any given quantity, at any given price, we're willing to supply fewer items. And just like with the demand curve, there's a list of items that shift a supply curve. So unfortunately for you, or maybe fortunately for you, because it'll be good mental exercise, in addition to lists of principles, and in addition to knowing that resources are scarce and the real cost of something is what you must give up to get it, and the list of interaction that starts with gains from trade, and that markets move to equilibrium, you're going to need to know that change in prices of related goods, change in income, change in tastes, change in expectations, and change in the number of consumers is going to shift a demand curve, and you're going to need to know the list of things that shifts the supply curve. It's the change in the natural conditions of production. Very simple, agriculture in particular is really affected by the weather and by the climate. Change in input prices, the higher an input price, the fewer amount of a good we're willing to make and sell for any given price of the good. So change in input prices will shift the supply curve. If input prices fall, we're willing to produce more. Change in prices of related goods or services. And now, again, the related goods are still the same. They are the substitutes and they are the complements. However, in this case, on the supply curve side, they are the substitutes in production and they are the complements in production. So let's say I have a factory where I can make either washing machines or refrigerators. And so I have an assembly line that I could move from one to the other. And let's say for some reason there's a big increase in change in tastes. Everybody wants our refrigerators. And so the price of the refrigerators goes up. Well, we're going to shift production away from washing machines to refrigerators, which means the supply curve for washing machines is going to shift to the left. We're going to be at any given price of washing machine, we're going to be willing to produce fewer washing machines because of the increase in the price of refrigerators. And that's because refrigerators are a substitute in production. We can produce one or the other on the same assembly line. Increase in the price of one leads to a shift to the left of the supply curve of the other. There are also such things as complements in production. And the big example right now has to do with the fracking that occurs. And when they drill for oil, they produce natural gas. Now, I can't remember now which is which, but I think it's when you're drilling for oil, you end up producing a lot of extra natural gas. And so if the price of oil goes up and we're going to be drilling for a lot more oil, it's going to increase the supply of natural gas. The natural gas is going to shift to the right. So for any given price of natural gas, we're willing to produce more of it because the price of oil went up. And we're drilling for oil, and because of that, we create a lot of natural gas as a sort of a complementary good. So complements in production are when you're producing one and the other one gets produced as well. And then a substitute in production is the idea of we have perhaps some particular resources that are suitable for producing either, say, washing machines or refrigerators, and we're shifting them from one to the other. And the price of change in the price of one will affect the supply of the other. Changes in technology is another thing that will shift the supply curve. We hope that it's always shifting the supply curve to the right. Certainly the history of the economy up until now, really starting from prehistoric days, is that technology has always increased and has increased our ability to produce. So we generally assume that the changes in technology always move in just one direction, moving the supply curve to the right. Changes in expectations, similar to on the demand curve, but opposite, meaning if we think that prices are about to rise, we're going to hold off production now, and we're going to wait till those higher prices kick in, and then we're going to try to sell. So if we think prices are going to rise in the future, it'll actually decrease current supply. And if we think prices are going to fall in the future, we really want to sell the goods now before the price falls. And so an expectation that prices are going to fall in the future will increase current supply. Changes in the number of producers, similarly to on the consumer side, the more producers we have, the greater the supply is going to be for any given price of the good. And then finally, changes in taxes and in government regulation can shift the supply curve. Taxes are a cost. We might think of it behaving in the same way as the input price. The higher the tax, the less we're willing to produce at a given price of what we're selling it for. And then regulations also in general add to the cost of doing business. And the higher the regulatory burden, the shift to the left of the supply curve.